Welcome, everyone. My name is Emily Farnworth. I'm the co-director of the Centre for Climate Engagement at Hughes Hall at the University of Cambridge. And we're very focused on really supporting the chairs and non-executive director community to really understand the latest research and developments that are going on that will affect how they make decisions in the boardroom to drive change and to drive climate action. We're delighted to be here hosting this event with Chapter Zero and looking forward to a discussion around some of the requirements of the new Pension Schemes Act that was introduced in the UK earlier this year. And in particular, what's the sort of role of, what do pension trustees need to do differently? And what are the roles of chairs and non-executive directors in understanding what this regulation means for boards and for the corporates that are interested in understanding how and where their own pensions are invested. Before we dive into talking a little bit more about the structure of the event, I'd like to introduce Robert Jennings, who's on the board of Chapter Zero, to do a brief introduction. Robert, over to you. Robert, I think you just...
Good morning, and thank you, Emily, for that. I'm currently a non-executive director on two listed infrastructure funds, one of which is Sequoia Economic Infrastructure Income Fund, and the other is 3i Infrastructure. And together they have a market cap of around £5 billion. And as Emily's mentioned, I'm also a non-executive director of Chapter Zero. And I should say at the outset that I'm not a habitual reform radical, or even for that matter, historically a tree hugger. But over a period of time, I have become increasingly convinced that mankind faces a very serious threat to the good lives that we have all enjoyed in our lifetimes, and that this threat can only be mitigated by making significant changes to the way we do things. This need extends to pretty much everyone and certainly every company on the planet. But on the positive side, it does not mean that the quality of our lives has to suffer greatly if we act in a timely manner. Chapter Zero's purpose is to help NEDs, primarily of listed companies, to for meaningful boardroom discussions on the impacts of climate change. And since our launch in 2019, we've attracted more than 1,500 members. And through our website, webinars, events, toolkits, and networking facilitation, we are helping to support, inspire, and educate NEDs on all matters relevant to climate change governance. I mentioned we've been primarily focused on NEDs of listed companies, and actually about half our membership, half our current membership, sit on the boards of FTSE 100 or FTSE 250 companies. But we strongly welcome also persons who serve on the boards of large unquoted companies and trustees of pension funds. So if you are not already a member, I would encourage you to look at our website, www.chapterzero.org.uk. It is a very interesting source of information, and you would hopefully find it a good source of guidance on a continuing basis as we all make the German journey to decarbonisation and sustainability. So please do sign up to become a member. It's also completely free, so why not?
Thank you so much, Robert. I really appreciate that introduction. And as you say, you're coming from this from an extremely interesting angle. So it'll be great to kind of get some of your thoughts on this conversation. So the conversation today is very much sort of centered around the requirements of this new act. But what we really wanted to understand is, what's going on with pension trustees at the moment? How are they responding to this new regulation? And in particular, what do non-exec directors need to be thinking about in terms of the questions they need to bring to the boardroom, both in the context of responding to questions from pension schemes that are invested in their own businesses, but obviously also thinking about where their own pension schemes are invested and what their employees might expect to see from those investments. So we're going to introduce a great lineup for you today. We have representatives from pension trustees, from the non-profit organisations looking into this into more detail, and also from obviously kind of the kind of non-executive director perspective themselves. So I'd like to firstly introduce Russell Pico, and maybe Russell, you can do, if you could just briefly talk a little bit about your experience in this area, given that it is something that you've been working on, and as chair of the trustee board at HSBC, as well as the trustee board director at the university's superannuation fund, I think you've probably got a lot of experience already to share with us today. So Russell, over to you for a brief introduction.
Thanks very much, Emily, and morning everyone, and it's great to be with you all this morning on what's a really important topic of conversation. So as Emily said, I'm a trustee of two very large UK pension schemes. Both of those boards are very clear. Climate change risk is a financial risk, and we need to manage it like any other financial risk. And I think we understand it's both got that very important financial dimension for our members, because this is going to influence what their pensions are in retirement. But equally, as Robert so rightly says, it's also going to have a really important influence on the quality of life they enjoy or don't enjoy, according to what happens to climate change. So we understand it's a really important issue. I think increasingly pension funds are spending more time getting to grips with this issue, which is very welcome. They obviously can only do a certain amount by themselves, but they can collaborate with each other and actually help support each other in the efforts to try and bring down the global increase in temperature. Thank you.
Thanks, Russell. And I'd also like to introduce Bethan, who's the Director of Policy at Share Action. And Bethan, maybe you could just talk a little bit about sort of Share Action's role in this conversation and sort of what you're observing so far.
Sure, yeah, thanks, Emily. So I'm Director of Policy at Share Action, and we're an NGO that's focused on responsible investment in the institutional investment space. And our mission is a world that works for people and planet. A financial sector that works for people and planet. And we go about trying to achieve that mission in a number of ways. One of which is we actually work with lots of investors to help drive up standards in companies through sort of helping investors engage and steward those companies. We do surveys and rankings of the investment sector. So we've just published a large survey of the world's largest insurers on their approach to climate change and biodiversity. And we do policy advocacy. And we very much see ourselves as a sort of insider-outsider way. So we're very willing and think that actually the way for us to all achieve progress on issues like climate change is to work together and see this as a journey that we can support companies and pension trustees as they work towards decarbonisation.
Thank you so much, Bethan. And maybe Mark, as chair of the UK Northern Trust Pension Scheme, it'd be great if we just heard a little bit more about your organisation, but also your particular focus on this topic.
Yeah, sure. Morning, Emily. So, as you say, I'm the chair of the Northern Trust Pension Scheme. It's actually a hybrid scheme, so it's a mixture of DB and DC. So unlike Russell, I think he's principally DB schemes. The majority of the money that we have is actually for the members, looked after for the members, and there is no corporate pension promise backing that up. So whilst we as a trustee, to various degrees, but as a group, believe the financial impacts of climate change need to be taken into account and we need to invest accordingly for them, we've got to tread a fine line between spending members' money and ensuring that, particularly for the older members, that if we were to make wholesale changes to the scheme immediately prior to them retiring, that could have a small but nevertheless could have an impact on their retirement outcome. It's also quite interesting that I feel a bit left out, if you want the absolute honest. The Pensions Act has come out and it's got these provisions for the over 5 billion to start with, then over 1 billion and at 300 million, but we're not included as a scheme. And I'm just kind of wondering whether that's right for the members, whether my members are second-class citizens compared to some others when it comes to climate change. So, in a nutshell, fundamentally believe in it, trying to do something about it, but having to tread that fine line between what's good for members when spending members' money.
Yeah, it's interesting, and I'm sure we'll kind of get onto this conversation about sort of, who should be actually thinking about these regulations, irrespective of whether they're actually covered by the current Act. I know for most of you that have signed up, there was a sort of background briefing that kind of gave a little bit of an overview about the key elements of the new regulation. But maybe just to kind of kick us off, maybe if I can turn to you, Russell, with a question. I mean, what do pension trustees, what do they need to do in the context of this new kind of regulation, and what are they going to be asking companies to provide to them?
Yeah, thanks, Emily. Well, I think the first question that trustees need to do is to understand climate risk and opportunities, climate change risk and opportunities. That of course is always the first step in the corporate boardroom. You can't really tackle anything unless you understand it. As Mark was saying, there's various statutory provisions which require schemes of various sizes to get to grips with this issue. Effectively, the requirements are for large pension schemes to follow the reporting requirements of the TCFD, so disclose information about their business strategy, the way they manage pension scheme risk, asked us to set some metrics and targets, and to run some scenario analysis showing the impact of climate change on the portfolio. It can be quite a lonely place, I think, sitting on a trustee board with an issue like this, because the reality is that there is a relatively poorly supported sort of systemic infrastructure around this at the moment. I think it's growing in terms of the knowledge of the investment consultants, but unlike, say, how do you choose to invest money in equities, where there's an extremely deep level of knowledge, everybody understands that. I think on climate change, there's a growing but limited level of understanding, and as probably people know, the HSBC scheme's got a very large open DC section, and we moved our default fund when we developed the Future World Fund 5 years ago with Legal & General. So it's got a climate risk tilt, so to give our members, our younger members, some degree of protection. But this journey of understanding, of really thinking through what climate change might mean in terms of financial outcomes, depending on the scenarios, and then to think about what steps you can take. And very interesting listening to Bethan speaking, and I'm a huge supporter of the work that Share Action does, that the steps can be really two things they can be doing. They can be collaborating with other pension schemes through organizations like Climate Action 100 to actually put pressure on companies to have transition plans to achieve a transition to a decarbonized world. And they can think about steps they can take to actually manage climate risk and to seize the opportunities there will be within their own portfolios. And I think it's important that they do both of those things, take the steps they can do directly, but also collaborate with others, putting their weight behind these moves to try and support system change.
And do you, just a sort of quick follow-up question on that, I mean, how ready does your sense that pension funds are, how much information do they already sort of ask for in this regard, or is this going to be quite a step change, do you think, for the majority of pension funds?
I think the large schemes probably have known this has been coming for a while. I mean, whenever it was a couple of years ago, there was a letter sent out by one of the Treasury Select Committees asking us all what we were doing. So that didn't tell people that something was afoot. I don't know what would. But I think there's a lot of difference between people knowing it's coming and of course, when it appears in an Act of Parliament, you have to do it. That really focuses people's minds, and I think that's where people are right now, Emily. They're very focused on getting to grips with this.
Yeah, and Bethan, maybe to sort of, from your perspective, where do you see some of this action already happening, and where do you feel that there's actually a need for sort of further, interventions, if you like, or kind of activity from the NGO sector to help move this along?
Well, I think just building on what Russell was saying, that some of the larger schemes obviously have already been exploring TCFD reporting and probably are in quite a good place as we kind of come to the the managing requirements. And equally, a lot of those schemes are already quite active stewards of companies and will already be often through their asset managers, but thinking about the transition plans or the net zero promises of companies within their portfolios. And they might well, for example, some work that Share Action's done recently, coordinating shareholder resolutions at large banks that's sort of looking at their net zero transition plans. And we do have pension funds who are keen to be involved as a co-filer in those. So I think it's probably splits a bit between the size and capabilities of the schemes. It's interesting sort of listening to Mark talking about the resources that he has, because I think what we probably need is a sense of how smaller schemes can get involved in a way that is commensurate with the resources that they have. And I think we probably don't have that. We have a bit of a separation between the schemes who are already engaged and on top and feel that they can challenge companies and challenge consultants to give them, resources and advice on this, and then the smaller schemes who just haven't been able, for whatever reasons, to raise this up their agenda or to get involved so much. So I think the more we see free resources and initiatives for schemes, the better. And I was just thinking about some resources that the government put out when it put out I think it was a consultation on TCFD. Published on the government website, they also put out some guidance from the Pensions Climate Risk Industry Group, which I think it was called PC RIG. But actually, that's quite comprehensive guidance that sort of walks trustees through how to report against TCFD. And I think that could be followed by any trustee of any size scheme who felt that this was something they wanted to do, whether or not they're within the current legal requirements.
Thank you for that, Bethan. And I guess, Mark, I now maybe quite sympathetic about why you're feeling left out in all of this. I mean, does that resonate with you? And in terms of what resources you feel are needed, and sort of, what's going to help with making sure what's happening with these bigger pension funds is kind of filtering down. How do you respond to that? And what do you think you need?
Well, it's I do like Russell's explanation of feeling a bit lonely. So we do need a bit more, but the smaller schemes rely very heavily on their employee benefit consultant, their investment advisor, and we're relying on them to oversight the managers. Most of our investments are through pooled funds, so we're one step removed from the underlying investments. So it's very difficult for us as a trustee to reach through that pooled fund to put pressure on the individual manager. Something else, just sort of slightly going to a slight tangent on this, is also we've put in place a lot of our investments. We put in place looking at a full business cycle, and for us now to take 4 or 5 years into a business cycle to cut a fund when the reason we bought it was for some performance over the total cycle, to cut it out, we might be doing a disservice to the members. So I think in my first request is going to be back to the employee benefit consultants, because those are the people where we get the majority of our advice from. Those are the people who oversight the managers, and that's where the increased focus on climate risk should come from in helping trustees of smaller schemes. Yeah,
that's a really important point, I think, and something again that maybe something to come back to in terms of the role of advisors in this kind of next stage of ramping up what's needed. Maybe Robert, you've been sort of listening to sort of what's happening in the marketplace, and also the fact that there has been quite a lot of work already being sort of, or groundwork being laid for kind of questions that pension funds need to be engaging with corporates on. Does this resonate with sort of, for where you sit, and sort of, how are kind of companies maybe responding to this in the context of the questions that are being asked?
Well, perhaps I could just sort of take a historical perspective one step back. My experience as a NED in the boardroom is that pensions are a worry principally because of the difficulty in meeting the associated expense of the schemes, be they DC or DB, and the opportunity cost, which is perceived to attach to the cash flows needed to support those contributions. And I suppose in the case of DB schemes as well, the size and the volatility of the deficit are rather can be mind-focusing issues. But typically boards, especially non-executives on boards, have allowed the interface with their pension scheme to reside with one or more of the senior executive team, be it the finance director, the chief risk officer, head of HR. Apart from that, they tend to operate on rather arm's length basis. And I mean, Mark touched on, you know, even at the trustee level, there's a considerable value chain beneath the trustee before you actually get to the manager. So in a sense, on the sponsors board, there's just yet one more layer. That all makes it a particular challenge, I think, to see how a company's scheme is aligned with its own ambitions and goals. But I think that maybe this is an area that is going to be actually rather break the historic mold, because it seems to me to be completely perverse and incongruous that you can have a company that at the board level is setting a strategy that wishes to, and publicly standing behind that strategy, wishes to do things like achieve milestones or net zero by a certain date or whatever. And then if they completely ignore what's happening to their pension scheme, that seems a rather important part of their own value chain, which they're just ignoring. And so I sort of think that this, as I say, may make pensions and the investment strategy rather more closely followed by particularly companies who are ambitious to be leaders in this field.
Yeah, absolutely. And I guess, as employees perhaps get more interested in understanding this, that internal pressure and kind of asking, more people asking these questions, because the awareness, in this sort of general population is increasing on some of these risks. I would guess that might also filter up. I mean, from your perspective, in terms of thinking through the kinds of conversations that need to take place in the boardroom and the role of non-exec directors in bringing this in, I appreciate it. As you say, it's quite a delicate balancing act with all the different actors involved. But where could you see an opportunity for this to sort of be something a non-exec director can bring into the conversation?
Well, obviously there is one lever or angle that should be considered, I think, by all NEDs, and that is that in most schemes, I think it's actually in all schemes, because I think it's a statutory requirement, the trustee has to consult the fund sponsors on investment strategy periodically. And I think it would not be unreasonable to ask the finance director to report to the board on how investment strategy is being varied to address the issue of climate change and other wider issues, sustainability and related matters, and also how the trustees are ensuring that managers actually comply with the agreed strategy.
Yeah. Yeah, and I think that's a really sort of helpful insight. And maybe, Russell, I mean, you've obviously got quite a lot of experience of doing this already. Is there any sort of, does any advice or any kind of best practices that you can share to address some of the comments that have come up from the other panelists?
So I think there's probably a range of relationships out there between the trustees and the corporate sponsor. I happen to enjoy in HSBC a very close and a very supportive relationship with our corporate sponsor, which has been there for many years. So we naturally have a very open dialogue, and HSBC has its own corporate ambition around net zero. And as Robert was saying, it would be pretty strange if we ignore climate change given that corporate ambition. But there are other schemes where that relationship perhaps isn't so close. I think there are obviously going to be points of time within the trustee cycle where the discussion with the corporate is going to open up. So as Robert says, the discussion around investment strategy discussion around the actuarial valuation, which happens every 3 years. That is going to bring this into the corporate world, like it or not. And I think that having a good open relationship with your sponsor and getting that alignment really matters. I mean, I think it's increasingly the case that young people, when they're looking at what organizations they'd be happy to work for, do look at things like climate change. And as Robert says, it's going to be a bit incongruous if the pension scheme is completely ignoring it and is getting some adverse publicity because it happens to invest in a lot of very high emission companies and actually isn't doing its bit to try and bend the trajectory away from where we're heading at the moment.
Yeah, and maybe Bethan, if I can come to you to ask, in terms of sort of some of the levers that, the sort of the NGO community can pull. I mean, are there other things that need to happen, do you think, from the sort of, from an external perspective, whether it's increasing awareness to employees or I mean, obviously, the work that you're already doing is hugely effective, but just in a sort of broader sense, do you see there are other external levers that can help with driving this transition?
Yeah, I think so. I mean, I don't think they're all kind of sitting with civil society. I mean, I think so. The government's role that it's already playing, and it's having this TCFD roadmap to make TCFD reporting mandatory across the economy will help, obviously, because there'll be greater disclosure and data available for companies and for schemes. But I think ultimately disclosure can only go so far, and that what we do need to see is some kind of scrutiny of the actual activities that are happening, or if you like, the kind of robustness of the net zero transition plans that companies are putting forward and that some pension funds have chosen to put forward. And I think sort of one of the interesting parallels between the corporate and pension sectors is that in the corporate sector, where we've got companies putting forward transition plans, they're getting quite a lot of close scrutiny by shareholders, and shareholders really are playing a kind of accountability role and stepping up to look at whether these net zero plans kind of have the whole water really for the companies. But on the pension side, where pension schemes are making net zero commitments, it's slightly woollier, I think, as to who can play that scrutiny role, and who can in a sort of challenging but friendly way hold pension schemes to account to make sure that equally they are that their net zero transition plans are robust. And I think maybe there is a role there for the corporate board to play that, if you like, that sort of shareholder role for the pension schemes net zero plans, and to make sure that those plans really are credible, and because a lack of credibility in those plans would come back as against the company and possibly and the pension fund. So I think that there is a gap at the moment as to who's scrutinizing the net zero transition plans of pension schemes.
And maybe, Mark, to come back to you in terms of that point that you raised about some of the advisors on this. I mean, is that where you would see that kind of role fitting, or how, just in terms of thinking about the resources available to actually to do some of this work, to understand what's real and what's just a very grand sounding target but without much weight behind it?
Yeah, no, definitely. I mean, if I just I was thinking about this when we were just Russell talking earlier on, and just looking at some of the barriers to overcome. There's a lot. So if I look at the scheme that we have, the DB is nearly 98% invested in gilts. So from green approach to gilts, well, until the government issues green gilts, then I've got nothing really else we can do there. So that's the DB scheme to one side. As I said, the DC scheme is all in pooled funds. We've got to pay attention to the member beliefs. So I think for me, probably thinking it through as Russell was talking, because of the DC as the predominant piece, it's actually the members who I need to be talking to as a trustee, and the trustee group need to be getting the opinion of those members as to what they want to see, and how they want us to make funds available to them, either in the default or in the self-select options that meet green ideals. So I think it's much more, for me, it's going to the member and having then the employee benefit consultants support us with the right degree of information and transparency into the underlying funds so as we can make informed choices on behalf of our members. So I think that for me, it's much more about the membership, less about the corporate.
Yeah, interesting. We have a couple of questions that have come in, but Robert, before we move to the Q&A, again, any sort of just listening to this conversation about sort of, what external levers there are, additional to sort of some of the things that we've talked about. I mean, do you have any reflections that you wanted to bring in at this stage? You're just on mute at the moment.
I would like to add one, which is sort of a bit the role of the non-exec director. Then non-exec director community is not really recruited to be an investment fund manager. They're recruited to help the corporate with its own challenges, and to work with the executive on providing constructive criticism, etc. I think it's very difficult to impose back to the sponsors board the sort of direction of investment strategy completely, because as I say, the fixation of non-execs and the board as a whole is how do we provide the members of the corporate pension scheme with a good standard of living in retirement at lowest possible cost to the company, amongst many other variables and inputs that a board of directors have to decide how to manage the company's affairs and in the long-term benefit of the company. So I'm not sure that is but this applies more to defined benefit schemes, clearly, and I absolutely pick up what Mark was saying about defined contribution schemes, where I think the member should take responsibility for how their funds are allocated as best they can. But it's a difficulty. I don't. It's a perfect situation at all.
No, and that's kind of a good segue to one of the questions that we've had come in, which I guess this is mainly for probably Russell and Mark. But in the context of, we're obviously in a situation where we're already dealing with climate change and the impact that it's having. We're already seeing the effects on the economy. We're already seeing the effects on all sorts of different sort of sectors around the world. So in terms of what's happening now, what keeps you awake almost in terms of thinking about the current climate risk and the state of kind of pension investments at the moment?
What keeps me awake at night is that globally we're heading for something north of 3 degrees. We need to change that. That's fundamentally a really big risk out there to all investments, to be honest, Emily. And I think that brings with it particularly focus on the defined contribution schemes, because increasingly that's the vehicle which young people are invested in, and they're going to be invested in the markets for 30, 40 years, and so their investment returns will be dependent on what happens to climate change risk and whether or not we manage to manage it. So that definitely is a preoccupation. I think the question around the linkage between setting an ambition for net zero for a pension scheme and how you then translate that into particular actions you should take in the portfolio through the lens of risk-adjusted returns, I think is the other area, which is there's a lot of work being done on, well, in fact, in both of my trustee boards. We've got the executives teams working hard on that at the moment. And this question of, well, should you, for example, divest yourself of all oil and gas companies, or should you continue to hold the investment and try and influence their own transition plans, I think is a very, very live question. The timing of how you do that, should you be setting some sort of intermediate target at 2030, because as we all know, 2030 is a pretty crucial date if we're to achieve 1.5 degrees. So I think there's a cluster of these really quite important big issues. I think the other thing I'd just maybe say, Emily, is that There are a growing number of climate change or ESG tilted funds being brought to the market by the fund managers. So I think that's a very encouraging sign that it's going to give us all more choice. If we choose to invest through a pooled fund, if we choose to put our DC default fund into some sort of tilted fund, there's an encouraging range of new funds which are being created, which I think is really helpful.
Yeah, and I think you just sort of hit one of the kind of critical issues at the moment in terms of this sort of divest or engage conversation that's going on, which is just so critical to managing the transition, with obviously lots of very different views about the best way of approaching this. But Mark, you know, do you sort of share Russell's views on some of those areas, and are there anything additional that you would want to add?
Yeah, I do share Russell's views. The one thing I would add is that it's not a one and done. So we can make a change to the default fund, for instance. We can put a climate tilted fund in, but as more evidence comes to light, as more approaches come to light, we've got to go back and revisit that to make sure we're doing the right thing, to make sure that we've hired a manager who is going to be constantly reacting to new information, new science as it comes out. And I think, if anything, that's what probably keeps me awake. That have we done the right things now? That we've got a fund, we've hired a manager that is going to future-proof to future changes. And it is absolutely to that exclude or continue to invest and put pressure. If we were doing this 2 years ago, we'd have bought funds excluding oil companies. Whereas now the received wisdom is going much more to putting pressure on those oil companies to do something different. So I think for me, it's the non one and done nature of it, and you even sort of goes through your mind about whether we should have a standing climate agenda item on every trustee meeting, or even a climate subset of the investment committee. You know, it's going to be that important to us going forward.
Yeah. And again, maybe just Robert, I appreciate you're coming from a different part of the system, if you like, in terms of in terms of your role, but in terms of this conversation around the need for thinking about, do we need to use the investments that we've got coming through the sort of pension funds to actually support the transition, and therefore we do need to keep the money in the kind of these sort of difficult sectors that sort of need the transition investment opportunity, or do we need to sort of think quite radically about actually kind of shortcutting the transition and making sure that we really are kind of getting much more aggressive about moving money into sort of into organizations and sectors that are already well on the way to this low carbon transition journey, given the kind of dire situation that we're in from a climate change perspective. Just your perspectives on sort of this balancing act that we have going on at the moment from an infrastructure perspective would be really interesting.
I mean, to my mind, in the pension context, the discussion we've been having, it brings out exactly the key point, that you can't abandon oil companies. They're vital, and they have a lot of capital in them, and it's a question of, over time, redeploying that capital away from oil and gas exploration into renewable energy investment, or whatever it might be. So that is one thing. But I mean, the radical thing that I would like to see happen is that governments set out a long-term basis for companies and everyone to plan against by indicating some level of carbon price at different future dates. Because I think we were talking earlier about the value chain that in this aligning pension context. I mean, it's a very long process from the sponsor board down to the investment manager making the decision. There are many, many steps on the way and many interests to be taken into account. But if those interests could all be aligned against a single long-term planning framework, then I think that corporates and the investment community can then far more easily play the role to support the transitions that are needed.
Yeah, no, I think it's so interesting to sort of get a sense as to all the different actors that really need to come together and perhaps be even more ambitious than than this current regulation in terms of the visibility of kind of what those what those sort of roadmaps look like. And Beth, maybe from your perspective, and obviously civil society is is losing patience really with the speed of the transition that's going on. And there is a tension between, the expectation from certain groups to sort of, get to zero carbon, not even net zero carbon, sort of, tomorrow, which obviously from certain economies and sectors is quite, is almost impossible. But how do you sort of see this perspective, and how do we get to a place where different actors are playing a role, but that we can, that we can sort of speed things up without, causing too many disruptions?
Yeah, I mean,
maybe not possible.
I definitely don't have the silver bullet answer there, but I mean, Share Action's always been taken an engagement approach, but I think that what's important is that engagement really has teeth and focus. So it's one thing to put the investors to say that they're engaging and have chosen not to divest, but engagement then really is a commitment to scrutinize and understand the transition plans of these large high carbon companies in particular. And it's not just sort of fossil fuel companies, it's also companies within industries that rely on high carbon, and the shipping industry is one that sort of comes to mind, where it does seem that we do still have time for a transition for these companies, but we don't have time to waste through sort of greenwashing or empty promises, or kind of reliance on sort of carbon capture or things which are not yet proven. We really do need to have a frank discussion about whether these companies can transition, and I think it's part of the role of pension funds as shareholders, and whether they do that directly or through their asset managers, to have these conversations, and then they need to make a decision about whether or not these companies can be part of a transition. And I think that as you say, patience is running thin in civil society, but the practicalities of the economy are such that we do need to try and do this in a measured way, and to do a smoother transition as possible. And if engagement and stewardship can be part of that, I think that's a good route to take. But yeah, as I say, engagement is a commitment. It's not just a sort of, oh, we're engaging, we'll have a few conversations and sort of hands-off approach. You need to have a proper engagement plan, and that will potentially involve escalation and threats or actual divestment in the end. And if you're a pension scheme that doesn't have resources to do that themselves, you can talk to your asset managers about what they do in this respect as well. So I think there are things that can be done.
Yeah, no, absolutely. And maybe just we're not going to get through all the questions, unfortunately, but just a couple more that I'll put to the panel. Maybe just to continue on this theme of sort of this, as we're in this transition phase. And Robert, you brought up the issue of we're not currently really effectively pricing carbon, in all areas at the moment, and so it does pose this challenge where actually, from a climate change perspective, the wrong investments still look quite financially attractive. And some of the opportunities for investment maybe not so much, because we do have this kind of rather a different approach and regulatory frameworks in different jurisdictions. So I don't know, Russell and Mark, from your perspective of making those difficult decisions, how much do you rely on doing the right thing and kind of using the sort of physical risk data perhaps to drive the conversation, versus this sort of this tricky situation we're in with some of these investments looking quite attractive?
Yeah, I mean, I think this isn't a problem that we in the private sector can solve by ourselves, either through the initiatives of the corporate world or indeed the pension fund world. The role of government to protect civil society is hugely, hugely important. And as Robert was saying, we need government to set clear policy to enable then investment to be made with certainty. And the recent reports from the Committee on Climate Change are very clear government is lagging behind where we need it to be. And I remember listening to Chris Stark from the CCC about a year ago, I think, who said, he asked the audience, well, how many units of housing are there in the UK? And the answer was 30 million. And he then said, we have 30 years to make 30 million units effectively net zero carbon. That's 1 million a year. I mean, I hesitate to put a number on how many units we're actually tackling at the moment, but I suspect it's in the low tens of thousands. That's not something that the private sector or the individuals can tackle. That's absolutely a government policy question of setting the right frameworks. I think there is a real appetite, both thinking about the DB world, we in the DB world do have a genuine appetite for the right type of long-term investment. So infrastructure is a pretty natural place, I think, for DB investments to happen. We quite like inflation-linked investments because our liabilities tend to be inflation-linked. There isn't enough supply of index-linked gilts coming to the market, so we are all looking for other forms of indexation. And I think you're seeing in the DC space, and the USS has done this, it's brought illiquids into the DC default fund, and government, I think, is very supportive of that. So I think getting the right public policy framework, getting clear policies sector by sector to enable then the weight of pension fund money to swing behind is really, really crucial. It also creates, obviously, for the corporate world, the right environment for them, for the entrepreneurs to create opportunities, and we can then support those.
Yeah, thanks, Russell. And Mark?
I'd echo a lot of what Russell said, just a couple of points. We're doing what we can with what we've got. We're trying our hardest, but we are going to need government to line up behind this. Just take the housing. Houses are currently built with no solar panels on the roof. You can put them up, you get no charging points on them. It's ridiculous that the government is allowing all this house building to go on without a green agenda for that house building. So we need the government to help us through this. So we're doing what we can with what we can. I take Russell's point about illiquids. We would love to be able to offer illiquid assets to our membership, but it's very difficult to do in a daily dealing environment where the members have the ability to come in and out on a daily basis. USS have done it because they're using their DB asset book as a backstop for those illiquids. So I don't want to be a sort of Cassandra with this thing, but it is very, very difficult to do a lot of this stuff effectively when you're working through funds and daily dealing environments. So we do need government to line up and make the change at the top end, so as everything just flows back through to us.
Yeah, no, I think that's sort of come across in a few different pieces that we absolutely need more government direction on a number of different issues. Just a final question, it's a slightly different question, and I'll open it up to those who want to answer this one. But it's really just thinking about sort of the pension fund members themselves and sort of where that engagement is happening and sort of maybe I guess from Russell and Mark, your own experience, and maybe Beth Ann too, sort of where do you see that engagement starting to grow, but what more can we do to actually make sure that increases as part of this as part of this ecosystem of getting change to happen? So Russell.
Yeah, and I think it's right. And Mark said this earlier, actually. It's really important for trustees to understand what their members think and what they want us to do. And that obviously means that it helps us inform the choices which we offer members. I think when you're thinking about the DC default fund, that's pretty firmly a trustee decision. But I think understanding the views of our members is important. And campaigns like Make My Money Matter, for example, have been quite successful in encouraging engagement and members asking the question of trustees, well, what is my money invested in? And I think just like any other corporate board, trustees are sensitive to pressure. I suspect that will grow. I think we've had a case in Australia, haven't we, where there's been a successful case taken by a young member against a pension fund for not taking action around climate change. So the legal route is perhaps the last route, but I suspect that that's where frustrated people go, isn't it? So hopefully we can avoid that by having enlightened trustee boards talking to their members and listening to them.
Well, it might be quite good to create a bit more visibility around that case, just to rattle, just to make sure you're right. It absolutely should be the last resort, but it perhaps is a thing that sharpens people's minds. So, yeah, Mark, your view on this.
Yeah, again, I find myself in violent agreement with Russell. We haven't gone to our members yet. We will be going to our members to seek their views. And if we look back at the Defined Contribution Investment Forum, which is an industry body that we are a member of, they did an ESG attitude survey with about 1,800 DC members. They did it about 4 years ago and then redid it again last year. And all of the measures within that were very clearly up in terms of what members wanted from their schemes. They wanted them to be carbon neutral. They wanted them to be net zero. They wanted ESG incorporated in it. So I think the time is right now for us to go to members, and we will be going to members to get their views.
Yeah, no, it's interesting, isn't it? There's so many surveys now that sort of show this trend, and it has to then sort of create some added and welcome pressure on how we change things. I'm conscious of time, and I just want to make sure that we've got an opportunity for everybody. Obviously the main purpose of this conversation today was to start to sort of raise awareness about the requirements of this new Pension Schemes Act, given that it is an opportunity to really focus in on what pension funds need to do around climate risk and opportunity. But at the same time, really keen to hear from you, kind of just listening to sort of what your colleagues have been talking about, and also kind of knowing yourselves what the kind of priorities are. Maybe just if you could give us a sense as to what is the sort of the one or two things that you really would like the broader kind of community, if you like, to work on to help you do your job better in the context of the different roles that you play in this system. So it would be really wonderful to hear from everybody, sort of what their ask would be from from a next step around making sure that we can really drive this transition much more quickly. So maybe I'll go to maybe if I go to Beth Ann first, just to get your views on what we need to be doing more of, or we need to be doing something that we're not doing at the moment.
Sure. I mean, I would say I support Russell's and Mark's comments about the role of the government here and the need for a plan for a whole economy transition. But just looking at specific things that trustees and directors could do, I would just say to really scrutinize and understand, and where necessarily challenge. So really get really try to understand what a good net zero or transition commitment looks like, so that you're able to ask the right questions and to hold whether it's your own company board or the pension fund trustee board or other companies to account on the commitments they're making, because we really need these commitments to be credible, and so I think we all need to kind of get up to speed on what a credible net zero commitment includes.
Thanks, Bethan. Mark.
Yeah, my plea is around education. So trustees, they're well up to speed on LDI, on liabilities, on meeting all the regulation. But it's interesting if you look. So TPR is pushing out a lot of stuff on ESG. There's nothing in the trustee toolkit, which is the standard baseline education for trustees on ESG whatsoever. And we found in our own particular trustee, getting that baseline of understanding of ESG, climate change, how to measure it, what I should be asking for, and how I should react to what I'm getting is probably not where it should be. So if I have a plea, it is of the employee benefit consultants, TPR, the regulators, to help us with some better education around bringing all trustee boards up to a level set around climate change and ESG.
No, that's really helpful and seems eminently doable. So something that we can certainly sort of see how we can help with that process. And Russell.
Mark nipped in. That would be my number one ask as well. Actually, it does seem incongruous that you can do the trustee toolkit, but there's nothing on climate change. I think to go with that, Emily, I think it's really important that there are there's narrative and stories. I think we all like to understand what others have done. So creating a growing body of success stories where not just trustees of the very largest schemes, but trustees of medium-sized and smaller schemes have actually successfully tackled this question, and where they can share in a very open way their own experience, I think is terrifically helpful. I mean, we're all in this together. This is not some sort of competition where pension scheme number one is trying to outdo pension scheme number two. You know, we all benefit from the whole system moving together. So I think creating these stories and sharing them would be my other request.
Yeah, and I think, you know, it's really important, Russell. Thank you for that. And I think I think it helps to actually bring to life the reality of what's happening, rather than, you know, just, you know, lots of sort of, you know, platitudes sometimes. Makes it real for different folks. And finally, Robert, your reflections, and I guess, you know, inevitably, also with your sort of chapter 0 hat on, you know, sort of what you think perhaps we could be doing more of over the course of the coming sort of months.
Okay, well, I might start with my infrastructure hat on and just sort of give an illustration, which I think, you know, does help understand the dilemma that we all face. You know, at the moment, there is no regulation on what type of concrete you use, what sort of steel. That's why I mentioned, you know, a pricing framework over time, because this would allow companies to say, okay, at that point, hydrogen produced steel begins to be really interesting and probably the cheaper way of acquiring the steel we need for a project. Likewise, concrete, you know, so that's, you know, those, but you can do it by regulation, but by putting everyone into the same basket. But I think the price mechanism tends to be more effective than regulation. The other thing I'd just say in response to some of the comments from the pension trustees on the panel, that I mean, I'm a non-exec of Sequoia Economic Infrastructure Income Fund Limited, and we, both the investment advisor and we, see on a loan portfolio of non-investment grade loans to infrastructure, economic infrastructure companies, that, you know, writ large is the word risk around climate change. We've got no upside in that we're not an equity investor, we're purely debt. And we've therefore developed our own, and it's by no means perfect, but it shows you can do quite a lot with the information that's presently available, our own way of quantitatively measuring the portfolio, both the weakest ESG loans in the portfolio to the strongest, but the mean, the median, the deciles over time. And I think, and just using, well, obviously we get quite a lot of information because we're a lender, but actually, you know, just grading things, you know, does it fall into renewable energy? Does it become, is it enabling the transition to a lower carbon world? Is it infrastructure with a social benefit? And you know, using a rigorous methodology to quantitatively score, and then apply those scores across to each loan individually. And then, as I say, you can track the progress of the portfolio over time. And my sense is that over time, the risk of climate change grows. So it makes sense to try and push your portfolio towards a higher score, so that you are reflecting a better position quantitatively and objectively in the climate context, because it's very difficult to disaggregate all the qualitative commitments. The potential for greenwashing or for failure to achieve objectives or whatever is just so huge.
Yeah.
That I think that you need a bit more rigor. And in time, of course, with TCFD, we will have data on everyone's emissions. We haven't got that at the moment, but it doesn't stop you doing quite useful things now. So that would be my suggestion, as well as a carbon pricing commitment, is, you know, that people, there is quite a lot of information there, and it's a question of using it.
Yeah,
and analyzing.
more kind of use of tools and existing data in the short term as we sort of, grow the kind of the regulatory frameworks and the requirements over the longer term. Now, I think, look, I appreciate that we're at time, and it's been such a rich and valuable conversation just to kind of kick this off with some extremely useful suggestions over what needs to happen next. So really looking forward to working with all of you, and I'm sure others who've been listening in to think about how we can start to accelerate the requests that you've all had in terms of what we need to do next. So thank you all so much for joining, and thank you all for listening in today, and look forward to staying in touch as we move forward on this agenda. Thanks, everyone.
Thank you. Bye-bye.
Thank you. Thanks everyone. Bye-bye.